Yo, what's up, everyone? So, we got episode 4 of Macro from Zero, and today we got GDP, as we mentioned in the last episode. And without more, let's just jump straight to it. With episode 1, we covered interest rates, then inflation, then labor markets, and now the second field, the employment side of the dual mandate. Today we covered the scoreboard. So GDP, gross domestic product, is the total measure of everything an economy produces. It tells you whether all of this, the rate hikes, the tightening, the jobs data is actually working, or whether the medicine is killing the patient. You can fight inflation by raising rates, but if you raise rates too aggressively, you kill growth. GDP tells you which side of that line you're on. That distinction, growing economy versus shrinking economy, expansion versus recession, is one of the most powerful drivers of long-term currency trends. So let's start right into what is GDP. So GDP is the total monetary value of all goods and services produced within a country's borders in a given period. Measured quarterly and annually, it is calculated using the expenditure approach. Four components add up to GDP. Consumer spending. Everything households spend on goods and services: food, rent, healthcare, cars, entertainment. In the US, consumer spending is roughly 70% of GDP. This makes it by far the most important component. When consumers are spending, the economy grows. When they stop, it contracts. Investment. Business investment in equipment, machinery, software, construction, and inventory. Also includes residential investment. More volatile than consumer spending and often leads economic cycles. When businesses stop investing, a slowdown is usually coming. Government spending. Federal, state, and local expenditures on goods and services. This does not include transfer payments like Social Security or unemployment benefits. Those do not count as direct purchases. And net exporters, exports minus imports. If a country exports more than it imports, this adds to GDP. The US typically runs a trade deficit, so net exports are a GDP drag. A strong dollar makes exports expensive for foreigners and widens the deficit. So a simple formula, complex to move. So how GDP is measured and released? GDP is released quarterly by the Bureau of Economic Analysis. Sorry about that. But it is not just one release per quarter. It is free. Advanced GDP estimate, released about 4 weeks after the quarter ends. The first reading based on incomplete data, so it is the most volatile and subject to revision. It is also the one that moves markets most, because it is the first look at how the economy actually performed. Preliminary GDP, second estimate, released about 8 weeks after the quarter ends, incorporates more complete data, usually a modest revision, but occasionally significant enough to flip the narrative. What is this? There's like burning smell in my room. I don't know what it is, but it's really hard to breathe right now. So sorry if I'll be reading kind of awkward or something. So final GDP, third estimate, released about 12 weeks after the quarter ends. The most complete picture rarely surprises dramatically at this stage. The advanced estimate is the market moving release. There is the one to mark in your calendar. The others matter primarily if they reveal a large revision. US quarterly schedule, Q1 advance, January to March. Released late April, Q2 advance, April to June. Released late July, Q3 advance, June to September. Released late October, Q4 advance, October to December. Released late January. GDP growth is reported as an annualized rate. If the economy grew 0.6% in one quarter, the BEA annualizes it to roughly 2.4%. When you see a GDP headline of 2.8%, that is annualized, not the actual quarterly number. Always remember this when comparing to other countries, which often report actual quarterly growth. So what the numbers really mean? Here is how to read the GDP growth levels. Above 3%, strong economy running hot. If inflation is also elevated, the Fed stays hawkish, the currency tends to strengthen. 2 to 3%, healthy and sustainable. The sweet spot, Fed can hold rates steady. 1 to 2%, sluggish, below potential, the Fed may start signaling cuts, currency softens. Below 1%, stall speed, recession risk rising, markets start pricing cuts more aggressively. Negative contraction, 2 consecutive quarters of negative real GDP is the technical definition of a recession. What is a recession exactly? The technical definition is 2 consecutive negative quarters. The official arbiter in the US in the NBR, which uses a broader set of criteria: income, employment, industrial production, and retail sales. The NBR declaration often comes months after the recession has already started, which is why markets watch GDP prints in real time. This matters. In 2022, the US had 2 consecutive quarters of negative real GDP, Q1 at minus 1.6% and Q2 at minus 0.6%. That met the technical definition, but NBR never declared a recession because the labor market remained very strong and the Fed kept hiking. The dollar kept rising. The textbook recession trade, sell the dollar, buy bonds, completely failed. Lesson: GDP alone does not tell the whole story. Read it alongside inflation and labor data. Why GDP moves currencies? The link between GDP and currencies runs through the central bank, same as inflation and labor markets. Strong GDP gives the central bank less reason to cut and more reason to stay elevated. High rates attract capital and strengthen the currency. Weak GDP puts pressure to cuts, causes capital outflows, and weakens the currency. But GDP moves markets differently from CPI or NFP. Here is why. GDP is backward looking. By the time the advance estimate is released, the quarter is already over. Markets have spent weeks processing CPI prints, NFP reports, retail sales, and PMI surveys. They already have a reasonable idea of what GDP will show, so the release confirms or contradicts the existing narrative. It does not usually create a new one from scratch. When GDP is hugely market moving, when the advance estimate surprises significantly. A 2.8% print when markets expected 1.5% is a major USD bullish event. A minus 0.5% print when the markets expected plus 1.5% is a major USD bearish event. 2. When GDP turns negative for the first time. The first quarter of contraction always forces a repricing of the entire rate path. 3. When GDP changes the central bank trajectory. A surprise GDP miss that causes the Fed to signal pause is far more significant than the print itself. The dollar paradox in recessions. In a US-specific recession, the dollar typically weakens. The Fed cuts, capital leaves, but in a global recession, the opposite often happens. The dollar strengthens as a safe haven because investors flee to US treasuries. This is called the dollar smile. USD strengthens at both extremes and is weakest when the global economy is in moderate expansion. So real versus nominal GDP. This distinction trips up a lot of beginners. It matters enormously. Nominal GDP measures economic output in current prices. If prices went up 6% and real output stayed flat, nominal GDP would still show 6% growth. This is misleading. Real GDP adjusts for inflation, it strips out price changes, and measures actual growth in output. This is what economists and central banks care about. When you see GDP figures quoted in the financial press, 2.8%, 1.4%, minus 1.6%, they are referring to real GDP. Why does this matter for traders? A country can have a nominal GDP growth, but real GDP contraction if inflation is very high. In 2022, the US had 2 quarters of negative real GDP growth, meeting the technical recession definition. But nominal GDP was still positive because prices were surging at 9%. The NBR never declared a recession because labor markets remain strong. This created enormous market confusion. Was it a recession or not? The Fed kept hiking because inflation was still hot, the dollar kept rising, and the textbook recession trade sell the dollar by the bonds completely failed. The GDP deflator is the inflation measured embedded in the GDP calculation. It bridges nominal and real GDP. If nominal GDP grew 8% and the deflator shows 5% inflation, real GDP grew roughly 3%. Always confirm whether a GDP figure is real or nominal before reacting. Central bank policy is driven by real GDP. When the Fed says the economy is strong, they mean real output is growing, not that inflation is making nominal numbers look good. So the yield curve. Now I know we didn't go over yields yet, but let's just go right through this. Before the toolkit, I want to give you one concept that sits at the intersection of everything we have covered across 4 episodes, the yield curve. The yield curve is simply the chart of treasury yields at different maturities, from 3 months out to 30 years. Normally, longer dated bond yields more than shorter dated bonds. Investors demand more compensation for locking up money longer. This is a normal upward sloping curve. When the curve inverts, when short-term rates are higher than long-term rates, it is historically one of the most reliable predictors of recession. Here is the logic. If markets expect the economy to slow and the Fed to cut rates, long-term bond yields will fall. Eventually, they fall below short-term yields. The curve inverts. The market is saying rates are going to come down because growth is going to slow. The most worst version is the 2-year minus 10-year spread. The 2S 10S. Every US recession in the past 50 years was preceded by the 2S 10S inversion. The curve inverted deeply in 2022 as the Fed hiked regressively. By 2024 and 2025, it had been inverted for longer than almost any previous episode before finally beginning to steepen again. Why does this matter for Forex traders? An inverted curve is a leading indicator of slowing growth, which leads to rate cuts, which leads to a weaker currency. Holy shit, why am I talking like that? But the time can be 12 to 8 months between inversion and actual currency weakness. Because the Fed typically keeps hiking into inversion before eventually pivoting. The yield curve connects everything: interest rates from episode 1, inflation from episode 2, labor markets from episode 3, and GDP from today. When the curve inverts, it is the bond market voting on all 4 simultaneously. Learn to read it. I'll make a video about that, but there's also, inverted yield curve and stuff like that. And yields, everything, blah, blah, blah. I'll make a episode about that too. But let's just finish this. And the GDP toolkit. Here are the exact tools and releases every Forex trader should check for GDP. US GDP Advanced Estimate. Late January, late April, late July, late October. 8:30 AM Eastern Time. Your highest impact GDP release. Always check actually versus consensus and note which component is driving the beat or miss. A consumer spending led beat is more durable than an inventory driven one. Atlanta Fed GDP Now, a real-time GDP estimate updated continuously based on incoming data throughout the quarter. Freely available at atlantafed.org. Every time a major data point releases, retail sales, trade data, construction spending, GDP Now updates. It gives you a live reading on where the current quarter GDP is tracking before the official release. Professional traders check this weekly, you should too. PMI surveys. Purchasing Managers Index, released monthly by S&P Global and ISM. The manufacturing PMI and services PMI are forward-looking indicators of GDP. Above 50 means expansion, below 50 means contraction. Released well before the actual GDP data, so they are your earliest signal on the direction of quarterly growth. A run of PMI readings below 50 is a strong warning that the GDP print will disappoint. Retail sales released mid-month. Since consumer spending is 70% of GDP, retail sales is essentially a monthly GDP pulse check, constantly strong or weak trend, and feeds directly into advanced estimate. GDP deflator reported alongside the GDP headline. If real GDP rarely grows, but the deflator is 4%, the economy is not as strong as it looks. All five together give you a complete real-time picture of what GDP is heading, not just where it has been. So conclusion, 4 episodes down, so we have interest rates, the mechanism that adjusts currency flows, inflation, the primary trigger for rate moves, labor markets, the second trigger and the inflation amplifier, GDP, the scoreboard that tells you if it is all working or if the medicine is killing the patient. These four forces together drive the vast majority of macro-driven currency moves. When they all point in the same direction, strong growth, hold inflation, tight labor market, Fed hiking, you get a sustained directional trend. When they diverge, growth slowing, inflation falling, Fed pivoting, you get a reversal. The 2022 dollar surge was these forces in near perfect alignment. The 2023 and 2024 pullback was them beginning to diverge. There is one more layer to add. Understanding the macro data is only half of it. Understanding how the central bank is interpreting the data and communicating about it is the other half. And a central bank press conference can override a CPI print, jobs data, and GDP number all in the space of 45 minutes. So in episode 5, we cover central bank communications, how to read central bank statement, what forward guidance actually means, how to interpret the tone of a press conference, and what being data dependent really tells you. Holy shit, I really can read today, but it's really because of the fucking burning smell I have in my room. But yeah, so that was episode 4 of GDP, and as I said, we'll go over bank communication in the next episode. Also, this was supposed to come out yesterday, but I wasn't home yesterday, like all day. There was a lot of shit happening yesterday, like the what is called with the sun, the solar eclipse or whatever, and also the Super Cup. And yeah, so I just recorded today. Hopefully that's fine. And yeah, so I think this was all of it for GDP. We'll have bank communication next, but before that I'll do one about general trading. And yeah, I'll see you all next time. So bye.